Bank collapses for dummies. Is your money safe? So now Silicon Valley Bank collapse. There's been tons of articles all over the place about this, but they're mostly in bank speak or financial speak. And I think most people probably don't really understand these articles. I'm having a video here with a few stories to try to show you in simple words how, examples how this all works. Also in Canada, we tend to think, our banks are safe, everything's solid here. And we think it's really simple. But the truth when you see it is actually, the banks basically are safe. However, the truth is, a lot more complicated than you think. And it's interesting to actually look at it and try to understand it. So what we're going to learn today is 3 reasons why Silicon Valley Bank collapsed, the 1980s story showing how matching maturities works, how bonds made them badly shaken and not stirred, referring to the bank. Beverly Hillbillies explain why no bank is safe. That's funny. What is a bank run? Alexander Hamilton's wisdom that Silicon Bank didn't follow, how social media makes your bank less safe, can CDIC make your bank safe, can government regulations make your money safe? Now, what are capital requirements and how do they make your money safe? Is your money safe in a Canadian bank? Have Canadian banks failed? Are CDIC and government guarantees 100% reliable? And then I'm going to give you my unconventional wisdom on what is the best way to protect your money. So first of all, let's look at there's 3 reasons why Silicon Valley Bank collapsed. The first one, I can show you with a story. So back in the 80s, so I was actually one of my first jobs out of university. I was working for a savings and mortgage company. And this is the time, when interest rates shot up to, 20%. So it was actually a really weird, interesting time to be in the savings and mortgage area. Now, the company I was with mostly made their money with mortgages and GIC. People put money in and invest, buy a 5-year GIC, they'll put it in a 5-year mortgage, and that's what they did. But at that time, you could get interest rates, the short-term deposits, 30 days, 60 days, 90 days, were paying more than 10%. And it was a huge thing. Lots of people were putting tons of money in those. So I have a chart here. This is, today, 2.5, and you see the 30, 60, 90 days. But at that time, every section, every 30, 60, each one of them was quite different. And they were over 10%. They were large amounts. So what we did is the company I was with, we had one of our staff every day would phone every bank and financial institution. This is in Winnipeg, get all the rates for every term. And then we would go 1/8% higher. We were in eighths at the time. 1/8% higher, and put an ad in the newspaper, which was the main way people advertised back then. And we were the highest in Winnipeg at every term, every single day. So tons of money came in. We got 40 million in, which is back then was actually quite a bit of money. And, all we did was we took that money that came in, we walked a block away. There was a bank there, Continental Bank. We bought deposits there. And that was it. We made the difference because they were at a higher interest rate, right? And so basically you could buy them there with 100,000 minimum. So we got a higher interest rate. It generally about at 1%. So we're making 1% on this 40 million. And it looks like no risk, right? Because you just walk over to the bank and put it there. However, there was a risk. And so here's the risk. Let's say that the people putting their money with us all buy 90-day term deposits. And then we go to the bank and buy a 120-day term deposit. Now, when they all come due, if they want their money out, we don't have it because our money's not due yet. So the big thing is we have to match up all those maturities. So part of my role, and this was the accountant doing all the bookkeeping, but a part of my role was to actually track how much came due every month and all the money that we had at the bank and when it was coming due. And that was 30, 60, 90-day deposits. Plus it was also, 1, 2, 3, 4, 5, like GICs and mortgages. So we're tracking it so that, whenever money came due, if people wanted to take it out, we had to make sure we have about enough money. So this was the error that Silicon Valley Bank made. They had large deposits, like big companies putting large amounts of money in savings accounts so they could take out any time. And then what they did is they took that money and they bought 30-year government bonds or 30-year mortgage bonds, because in the US they have 30-year mortgages, right? So, and that was the difference. They didn't match up the maturities at all. So this is what I love, this Warren Buffett quote: risk comes from not knowing what you're doing. And that's really what happened, is they really didn't really know what they were doing, or at least they didn't follow established procedure there. So it looks like what they were trying to do is they were thinking, well, if we invest 30 years, we get a higher rate, so we'll make it a little bit more. But this is exactly where the risk comes from. So that's reason number 1. Number 2 is they actually lost a lot of money on bonds. So this James Bond reference, but it's the bonds that they put the money in. They put the money in 30-year bonds. And you think, oh, yeah, they're government bonds, right? So they're safe. That's actually not really true, because what happens, 30-year bonds can lose money when interest rates go up. So to illustrate, so if you have a bond, a 30-year bond, it pays 2% a year. And now the going rate is 4%. If you go to sell your bond, nobody's going to give you the full value for it, because there's other bonds out there paying 4, right? So you're going to lose less. So back in 2021, these 30-year bonds paid about 2%. By the end of 2022, they were paying about 4%. And that actually, for a 30-year bond, is a 30% loss. So they lost 30% on all this money. So now the banks always keep some capital around, but that 30% was more than the entire value of the company that they lost. So that was their big problem. They lost money on the bonds. Then, so I just went to see Alexander Hamilton, or Hamilton, the musical. This is the third time I've seen it already. An amazing story. So this is a guy who was born, with 3 strikes, not one, 3 strikes against him, and yet ended up becoming one of the founding fathers in the States, and major part of contribution to writing their Constitution. And basically he mostly set up their financial institutions, the system with the central bank and central government and all that. So a lot of what he did rings through today, from a guy with so many disadvantages. But okay, one of the wisdoms that he had, the U.S. had just become independent from Britain, and they had 13 states at the time. And one of the things is that each state kind of had their own banks, and each was their own area. And his vision was, we need a government, like a central bank, that covers all of the U.S. so that they're not all in one place. What can happen is you've got your money in a bank. Okay. And if you have all of one type of customer, or your money's all in one place, then that's when they can take a lot of it out. So what makes banks safer is if you have money that's in many different areas, like your banks are all over the place, and you have many different kinds of customers, because then they don't all take their money out at the same time. So that was the insight that Alexander Hamilton made. They set up a central bank. And this was the big problem here. So Silicon Valley Bank, the bulk of their deposits were from tech startups. 2020 was the big technology year. Everybody's shut down in COVID. Technology had an awesome year. And a bunch of companies put their companies out on the stock exchange, got tons of money, and they put the money into a bank account. And now Silicon Valley catered to them, and all the money's in there. And now what they're doing is they're living off that money for a while they're trying to grow their businesses. So they have all this money in bank accounts, and it's coming out. And meanwhile, they've got this money invested long term. Now, there's a few other banks that have actually gone down. There's basically 8 of them that are having major problems right now. So First Republic Bank, Signature Bank, and Silvergate Bank, they also had a problem with basically one kind of money. A lot of it they had was people that made a ton of money in crypto and put it in their bank. But again, if too much of your money in a bank is one type of customer or one area, that a whole bunch of them could take money out at the same time. So you need to diversify. Banks need to diversify their customers, their type of customers, and their areas. Now, to understand why this is safe, remember back in the 60s, there was this funny comedy called The Beverly Hillbillies. And it was about a family of hillbillies that discovered oil on their land, and now all of a sudden had moved to Beverly Hills. So they still lived like hillbillies, and yet they had tons of money. Now, they had pretty well all the money with one bank, and there was a disagreement that they had with the bank manager at one point. So this is Jed Clampett went to the bank and said, okay, I just want to take all my money out. And this Mr. Drysdale, who was the bank manager, says, well, you can't take it out because your money's like invested all over the world. It's going to all over the country. It's going to take months to get it all back. And that's actually a really funny story, but it's actually kind of true. What happens is you put $100 in a bank. What they do is, rough numbers, they keep about 10% for their capital. And then 90% of it they lend out, and that money, gets deposited somewhere else, and they lend that out as well. So it's $100 deposit. They lend out 90. The bank only has $10. So the point is that no bank is actually safe. So if, for example, if everybody came and took the money out of a bank, there isn't a single bank in the world that would be safe, because they've lent out, the money's all over the place. So if you went and took it all out, they couldn't actually give it all to you at once. But what protects you is you have many different company customers all over the place. And why would they all take their money out at once? So, it's usually some people taking money out and put money in all the time, and it goes up and down, but they've got a good buffer on it. So now social media can actually be a problem here, because part of what happened was everybody found out really quickly, oh, there's a problem with a bank. All of a sudden, everybody's telling everybody, and voila, they're just all pulling the money out. And, because they were all in the same area, they all a lot of them were in contact with each other, and that made it much, much faster. So a bank run happens like we had these back in the 1930s when a bunch of banks collapsed in the Great Depression. And there the government bank didn't support them. And we had a whole bunch of banks that went bankrupt. So bank run is when a whole bunch of people start taking their money. All of a sudden they panic, oh my God, my money's not safe. And they all line up and they all want to take out their money. So you may have seen on TV, long lineup of people outside Silicon Valley Bank trying to take out their money, thinking, oh my God, my money is not safe. Let me quickly get it out before the bank goes belly up. But social media means everybody finds out way faster. So that actually, does actually increase the risk. So when you're putting money with a bank, really this is a whole, the entire financial system we have is all based on trust. And where there's trust and where money is handled properly, things work perfectly. But as soon as the trust falls aside and people don't trust a bank and they all start pulling their money out, that's when you get the collapse. Now in Canada, we have the Canada Deposit Insurance Corporation, and it guarantees your deposits. So it makes it 100% safe, right? Well, okay, the truth is, that's mostly true, but the truth is more complicated than that. So let's kind of take a look at it. So first of all, what is the Canada Deposit Insurance Corporation? It guarantees up to $100,000 on deposits. And the thing is, it does it by each name and each type of account. So you could have, for example, a non-registered account, an RSP, RIF, TFSA, RESP, RDSP, ITF, all of them. And also your spouse could have the same ones. And then also if you have a non-registered account, if you have a joint name instead of just your own, that's a separate 100,000. So, between a couple, you could have $1 million, $1.5 million if it's spread at just 100,000 per account, that would all be protected by the government. Okay, as long as it's spread out. Now, it's not that easy because a lot of these tend to be, much smaller, and most people have most of the money, for example, in RSPs and TFSAs and stuff. So it's not that simple. But you can have quite a bit that's protected by the bank. So basically the government is guaranteeing it. Now, that alone is probably more than it's smart to have for financial planning purposes anyway. I'm going to explain that more later on. So the guarantee is probably fine in terms of amount. And, in the US, it's $250,000. And interestingly, is this 100,000, that's been the amount for decades. They've never increased it. So that's, which is possibly a problem. So that's there, but I'm going to show you exactly how safe that actually is. So now, have banks in Canada failed? But we've had a few banks that have failed. There's been basically 3. We've actually had 43 different financial institutions in Canada that collapsed, which I'll show you in a minute. But so we had in 1985, Canadian Commercial Bank and Northland Bank. And so their problem was they were basically dealing with oil companies. And again, so all one kind of customer was kind of their problem. And actually, those banks actually got liquidated. Another was Continental Bank. Incidentally, my story of walking a block away and buying deposits? That was with Continental Bank. So, and they end up having a problem and with a forced sale to Lloyd's Bank. Now, most of all these institutions that have collapsed, we tend to think, oh, there's been nothing have gone down here in Canada, but most of them were mortgage corporations or trust companies. So even recently, you've seen mortgage corporations go under, but most of these happened back in the 80s and the early 90s. And it's a time that actually had a lot of parallels today. So that was the time when there was high inflation, high interest rates. The governments were spending tons of money, like huge deficits. Oil price was high. We had a different Trudeau as a prime minister back then. There's actually a lot of parallels to now. And that was, with really high interest rates, that's when it could be risky for banks. And, banks in general tend to invest their capital and stuff for longer terms than the actual money come in. And truth is, they don't really match the maturities perfectly because they assume only a certain number of percentage of people are going to take their money out at any point in time. And we could put a bit of it longer term and get a higher interest rate, right? So, but then when interest rates rise, that longer term investments loses more money. So, for example, if you have money in a 30-year bond and rates go up versus a 1-year bond, a 30-year bond can lose 30%, but the 1-year bond will probably only lose 2% or something. So because the interest is being paid over that many years, so interest rates go from 2 to 4 over 30 years. It's a much bigger loss than it's just over 1 year. So it's the long-term bonds that lose more when interest rates rise. So that's why things happen in those period of time. Now, also, since then in Canada, a lot of the financial institutions have merged. So there's actually very few trust companies or mortgage companies left anymore. Actually, I believe we have 34 financial institutions altogether in Canada. Like we've got 5 or 6 really big banks, and then a few others. But now, so the truth is that Canada's big 5 banks are all way too big, and CDIC couldn't actually protect them, couldn't actually cover them, all the deposits. So CDIC, if you look up their financial statements, I looked it up, they have 8 billion in assets. Okay, the Royal Bank has 2 trillion in deposits. So there's no chance that they could actually pay for that. All right. However, we've had 43 collapses, and CDIC did protect depositors. It's because they don't generally lose 100%. You just, you take some losses. And also what tends to happen, also CDIC can borrow from the government if they need, but what really tends to happen in the vast majority of cases when a bank goes under, they all merge. So I don't remember if you saw the movie about the 2008 bank collapse. What happened actually there, like 2008, the subprime mortgage thing, and it looked like the whole financial system was coming down. And basically, the Fed chairman brought all the CEOs of all the banks together and said, you're all going to pair up. So you with you and you with you. And the whole bunch of the banks merged. And that tends to happen here when a financial institution loses money. They are bought by another one. Now, what I had heard years ago, and I don't know if this is true yet, that Canada has kind of an unwritten rule that if one of the major banks loses money in 2 consecutive quarters, they get merged by another bank. Now, that's probably not true now. I believe it was true a few decades ago, but basically that is what happens. If a bank goes down, CDIC can cover a little, little bits of it that lose money. But for the most part, they're going to use the deposits, and they're going to maybe make a bigger bank buy them out, and that's how they kind of protect it. People tend to think you're perfectly safe with CDIC, but it's not that simple. Like, it usually protects small deposits. And because it does have a government behind it, there's something solid with it. But in reality, that's not how your money is safe. It's safe because they make the banks merge and they buy things out that way. Now, here, just so you know, this is from the CDIC website. These are the 43 collapses of financial institutions in Canada since it was created, I guess, in the late 60s. And you'll notice most of them were in the 80s and early 90s. That was, a different time back then. Now, so what about all the government regulations? So now we're relying on the banks to be safe themselves. And so what the governments do is they require capital. They have a capital requirement. The bank has to keep a certain amount of capital. And so remember what I said is that you put $100 in the bank and they keep 10% as their capital, and they lend out 90, and they keep that, so that if a bunch of people came in and took out their money, so if 10% of people came and took out their money, then they have the money for that. So if more than 10% came out, they have to get some of their loan money back. So, but usually, very few things would actually make 10% of all the money go out in one shot. So that would normally not happen. So after 2008, both Canada and the US raised their capital requirements, and in Europe, it's being done again. So Canada right now, it's about 11%. US is about 8% that they have to keep. So that's kind of the amount. And you know what? Under most normal circumstances, that's more than enough, much more than what they actually need. But so the issue again is, do a whole bunch of people, like, you got to think, what would actually make 11% of all the money in the bank, 11% of all the deposits, what would make them take it all out at once? And there's very few things that would actually do that. So now, is your money safe in a Canadian bank? So interestingly, our Canadian banks actually make most of their profits from their investment business. But between half and 2/3 of their profit is from that. It's not even from banking. So they have quite diverse. They have other sources of money. And they're massive, so if lots of people come and take money out, the banks are actually quite massive. So the big 5 are on average, about $1 trillion each. The biggest ones are about $2 trillion. That's all, all their deposits. So they're quite massive, and there is a lot of money around. In Canada, the banks are, all the major banks are all across Canada. They have many different kinds of customers. They're not all from one industry or, something like that. And their banks are, we have, it's called an oligopoly. We have, 5 or 6 banks. And a lot of Canada is like that. Like, remember, our cell phones, our car companies, we have a few big companies that kind of run everything. It's not, there's some competition, but not really that competitive. And, a lot of the regulations that we have in Canada keep everybody out in all these industries. So that's why we pay so much for cell phones. That's why, our cars are always a big negotiation thing. But banks our banks tend to be much less efficient than much of the world because we kind of protect them here and try to keep them apart. And you'll know that if you try to move money between Canada and the US, it's not that easy. So we're trying to protect our banks and have a few big stodgy banks. And the truth is, the banks really probably know what they're doing. Like, they have enough capital, they look at all these different ratios, they match up their maturities, and for the most part, they do know what they're doing. And if they didn't know what they were doing, they still wouldn't be safe despite everything, but they probably know what they're doing. And also, because our banks are much less competitive. You see it when they go to the US and try to compete there, they usually get beaten out pretty badly because they're not used to the competition like they have down there. There's like there they have 4,000 banks in the US. We have 34. So we're not used to, and only a few big ones. So we're not used to the competition. But in the US, you have lots of them, and it's much more entrepreneurial. People take big risks, and you can get some that take big risks. Here, they're probably not doing that. So this is the real reason why your money is actually probably safe in Canada. But it's not the reasons you think. It's not just because the government guarantees it. And it's not as simple as you think, because you see what happens with the capital requirements here. If 15% of all people came to the bank and took the money out all in 1 week, they don't have the money. So then we have to, they got to figure out what to do with it. Now, so let's talk about what is my view of the unconventional way is the way of how really to protect your money. But first of all, bottom line is, your money in the banks in Canada is basically safe, but it's not 100%. As if you see from this, it's not 100%. It's not completely guaranteed. You have to understand there's nuances about the risk. And I mean, it is theoretically possible that you could lose all your money in a bank deposit. If everybody started to pull their money out, they wouldn't have it, and it was a big collapse. And especially if they didn't match up their deposits, their maturities, and they lost a bunch of money. And so it is theoretically possible, even with all the government guarantees and everything. But it's just extremely unlikely, and they really kind of know what they're doing. The truth is, I'm not really worried about money in a bank. In general, you don't want to have all your money in a bank anyway, because you want it invested for financial planning purposes. You want it to grow for your future and provide for your retirement and all that. So you don't want to just have it in bank deposits. But anyway, I'm not really worried about the bank's deposits generally. Now, fixed bank deposits are basically a form of fixed income, bonds versus savings accounts versus GICs versus, bonds. These are all kind of fixed income that pay interest. And, the interesting thing is I've had this video a while back about the high risk of bonds. And it's, the funny thing is that the really big collapses usually happen in fixed income. People think this is where it's safe. I got a bond, it's a government bond, and I'm getting interest. See, that's why Silicon Valley Bank went under, because they had their money in 30-year government of US guaranteed bonds. That's why they went bankrupt. So they're not always that safe. So in fact, Buffett has actually sometimes called them, especially when interest rates are low, is calling them return-free risk. Usually what, risk-free, people say bonds are risk-free return. I'm getting a few percent, but it's no risk. But after inflation, bonds usually pay nothing. And so it's really, return-free risk. I'm going to show you a chart later on, what I've called the bond collapse. If you look at the history of bonds in Canada, between 1900 and 1982, government bonds in Canada made zero after inflation. And they made some money earlier. And then between 1940 and 1980, they actually lost 50% of their value after inflation. That was a period of time when interest rates were going up and up and up, which makes bonds lose value. Plus, inflation was really high, and the interest rates just weren't keeping up with inflation. So if you had enough money in, 1940 to buy 2 cars, you put it all in government bonds, waited the whole 40 years. 40 years later, you can only buy 1 car. So that was, I call that the bond collapse. So bonds do have long periods of decades where they lose money compared to inflation. When you look long term, you have to look at inflation. It's not I have the same number of dollars. It's a matter of what will those dollars buy for me. So people think you don't lose money in bonds, but there are, periods of time you do. 1918 was the biggest loss we had in Canada, 26%. Last year, 2022, was one of the biggest ones. Government bonds, the entire bond index in general, lost 15%, which you think it's safe, but that was there. And the truth is, for those that are watching what's happening, it was obvious it was going to happen. Now, obviously, the people from Silicon Valley Bank didn't know that, but it was really obvious. So, interest rates, you go back to 2021, they were like 1 or 2%. And then we had the government spending tons of money on all the COVID. So you realize tons of government spending, basically always leads to high inflation. So, interest rates are going up, but if interest rates are 1 or 2%, inflation was 2%. So interest rates were less than inflation. So there were only two scenarios if you go back to 2021. One is interest rates stay really low for a long time, which is really unlikely, but then you're basically losing, money compared to inflation for decades. The other one is interest rates go up and bonds go, lose a bunch of money. So, and that seemed by far the most likely one. So 2022 was a big loss in bonds, but it was pretty obvious to people, in the know, like who are following things and following what's going on, that this was probably going to happen. So either way, but there were only two options with bonds, and both of them were terrible. So now remember that. So the 2008 subprime mortgage crisis, stocks went down and real estate went down, but really it was the subprime. These was a fixed income. They were mortgage certificates that were people were buying that were guaranteed by a whole bunch of mortgages. So it was a fixed income thing that collapsed. Long-term capital management was the biggest hedge fund collapse ever, 1998. That was a hedge fund that dealt with bonds. And there's syndicated mortgages. You see them sometimes. You can buy syndicated mortgage investments, and they pay. And there's also we're called mixed mortgage investment corporations. So these things will pay, 6 or 7 or 8 or 10%, and you think, oh, it's interest rate that I'm getting all of my mortgages. But these things go down all the time, and a lot of times there's 100% loss. So and in fact, there's a website, VOSME, Victims of Syndicated Mortgage Investments, and these are the things where you lose 100%. Where your money's in a mortgage investment, but either the people don't pay, or they're all real estate project that goes down. Or, like a lot of the mortgage investment corporations were, for example, in Alberta, where real estate prices were going down. These are the things where you get losses a lot of the time. Or, it's fairly common to have, really big losses. So the way to protect yourself is, diversify. Like, you have to understand your risks that you have in these different things, but don't put it all in one place. Usually, so investors generally don't have all their fixed income in bank accounts and GICs anyway. They usually have it in bonds. And bonds, you're investing either directly with the government, who generally is more capitalized than the banks, or you're investing in companies who generally have money as well. So you're having your fixed income in bonds is generally safer, really honestly, than bank accounts. Although the risk there is actually more about fluctuation in interest rates, because bonds will go up and down opposite of interest rates when, GICs don't. In general, bank deposits, savings accounts and GICs are, I think, what people should use for short-term needs and emergencies. But this is not what you should use for your long-term investments, because you need that growth for your, to provide for your future. Now, equities, like people in the stock market, people think, oh, equities are risky and, bank accounts are safe. But, the thing is, these bank accounts and bond fixed income investments can sometimes lose 100%, if things don't work out. So, for example, in the we had this Credit Suisse is a bank in Switzerland that just went belly up just a week or two ago, and people that had invested in bonds there, they were wiped out completely, 100% loss. So the stocks went down quite a bit, but they got bought out by another bank, and yet meanwhile the bonds were wiped out. So you think that the fixed income is safe, but that's often where, like, usually there's not much fluctuation, but you can have 100% loss. So stocks, if you have a diversified portfolio, you're buying an index or a mutual fund that's properly diversified. It's invested around the world in different countries, and it goes up and down. It can go up, down, 30, even 40, sometimes occasionally 50%. The stock market goes up and down, but it comes back with some time. It goes through its fluctuations and it comes back. What happens? It doesn't lose 100%. Okay, 100%, if you're invested in, 100 companies, to lose 100%, all of those 100 companies would have to go bankrupt at once. Okay, so that doesn't happen. So you have to understand there's different kinds of risk. There's the fluctuation, short-term fluctuation risk. How much your money goes up and down over a few months, or even a few, 1 or 2 or 3 years, how much it goes up and down, versus permanently losing, your capital. So the real risk is permanent loss of capital, not fluctuations, because basically the stock market has come back from 100% of the declines in the past. That's the broad market. Individual companies have gone bankrupt, okay, but the broad market has always recovered. So remember, that's a different kind of risk than, the bank isn't paying me and I'm losing 100%. So it's important to kind of understand what the different kinds of risks are, and each kind of investment has its own risk. Every investment has risk. It's a different kind of risk and a different degree of risk. You just have to kind of understand what it is. Now, I've had a few videos on this before. If you've been following them, you understand this, but the point is that, nobody can retire comfortably with mostly bonds and GICs anyway. That's why you should only have, your short-term money there and maybe something enough so that you feel comfortable with your investments. But this is not where most of your money, this is not where you should have the bulk of your retirement investments that are growing. And here's a simple example. I've had a bunch of them in previous videos or podcasts, but you'll see it. So here's the typical example. So a couple is age 35, they're married, they make 50,000 each. They're just being these regular people. They want to retire 30 years from now on 40,000 each in today's dollars. So they're saving for 30 years, 3% inflation. Let's say they get the maximum on all the government pensions. If they're getting a balanced portfolio, so let's say half if it is bonds or GICs and half is in stocks, and they average 5% a year, they need $3 million to pay for this retirement. And to get there, they would have to invest 34,000 a year. It's 30%. Remember, they make 50,000 each, is 100,000 total. They have to invest 34% of their gross income to be able to retire that way. Now, nobody's going to be able to do that. So the point is that really nobody can retire comfortably if most of your money is in bonds and GICs. And see, if you invest it, all in equities, that's not everybody's comfortable with, but if you did and you average 8%, you only need 1.5 million because your money is working much harder. You have to put in 13% of your gross income. That's not even maxing your RSPs. So this is see how much easier it is that you take some risk with your investments, but fluctuation risk. But this is how you get the long-term growth. It's how you provide for your future, not by having all your money in bonds and GICs and worried about the bank. And so this is, the long-term picture, 200 years. Notice how stocks go up and down a lot. But the returns long-term have been very reliable. Basically, 7% real means after inflation. So the long-term return of the stock market is basically 7% after inflation. There are, years or even multiple years or sometimes even a decade or so where they're behind inflation or losing money or whatever. So, but over the long term, they're very reliable. So bonds, remember, so this was what I call the bond collapse. They had 40 years where it was really bad, from 1940 to 80. And then from 80 till now, till 2021, bonds basically did quite well because that whole time interest rates were coming down. Interest rates coming down makes bonds go up. So again, what I'm talking about is fixed income. This is, we're talking about, the topic here is about banks and GICs, but what I'm trying to illustrate is about fixed income and the issues that you can have with fixed income in general. So it's the perception that fixed income is safe when really it's not. You can have 40 years of down. We've never had 40 years of down with the stock market. So, and it's also the very term. So this is standard deviation, shows a measure of uncertainty of return. Bonds over short periods of time, rates of return after inflation. So these shorter term ones would be like GICs, 1, 2, 3, 5-year returns. And people say, well, GICs can't lose money because they're guaranteed. Well, but if your return is, your interest rate is lower than inflation, then you are losing money. So, and you also have to look at what's the range of returns after inflation that you get. So you're constantly comparing your interest rate to what inflation is. And so bonds are safer and GICs are safer over short periods of time, but you get to longer periods of time, 20 years and 30 years out, stocks are actually more predictable than bonds after inflation. So that's why we tend to think that, stocks are the risky ones, bonds are safe, and GICs are like 100% safe. It's not that way at all. And because we need to grow our money for your future and you need it to grow above inflation, stocks are really can actually be, for the long-term investment, can be a safer, more reliable investment than bonds or GICs. All right, well, thanks for listening. So this is what we learned today. We learned 3 reasons why Silicon Valley Bank collapsed. I gave you the 1980s story showing how matching maturities works, how bonds made them badly shaken and not stirred. So a James Bond joke. How the Beverly Hillbillies explain why no bank is safe. I showed you about what is a bank run, Alexander Hamilton's wisdom that Silicon Valley Bank didn't follow, how social media makes your bank less safe. Can CDIC make your money safe? Can government regulations make your money safe? And what are capital requirements, and do they make your money safe? And is your money safe in a Canadian bank? Have Canadian banks failed? Are CDIC and government guarantees 100% reliable? And then I just gave you my unconventional wisdom in, what is the best way to protect your money. So, okay, thanks a lot for listening. So, again, my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's edrempel.com. I've also got a YouTube channel that's been building up. And just last week, I launched a podcast. It's now out on 21 different sites. Yeah, you'll find it on my blog. Go to blog podcast. Actually shows all the different places where you are. And actually, whatever your podcast source is, I've made a simple way to find it. So if you just go to Google and type edrempel.com/Spotify or whatever your podcast host is, I'm probably there, because we have that for all these 21. We have that special short, easy to remember link that will help you find it. So the podcasts are going to be out. They're going to be one every 2 a week starting now. If podcasts are your thing, then I hope you enjoy them. For my blog, if you hit the contact button on the blog, you can ask for a free 30-minute consultation. And potentially interested in working with us, contact us, ask for a free 30-minute consultation. And it's not a sales thing at all. It's about trying to find out what you're looking for and what we provide, and are we a good fit to work together. Also, please like and subscribe to my blog and YouTube, and also to the podcast, so to help get the word out. Thanks again for listening, and we'll talk to you next week.